We're happy to have you all here today, and we're really happy to have Deborah Siegel, formerly from the IMF, with us today, and Leonardo Stanley from the Center for Economic Development and Societal Change in Buenos Aires with us today. We're calling our event Capital Account Regulations in the Trading System, and don't worry, I'll tell you what a capital account regulation is if it's not something that you think about every day. But in a lot of ways, we're celebrating a new report that you can get a free copy of in the back called Capital Account Regulations and the Trading System, a Compatibility Review. I guess the bumper sticker punchline of it is there's a little bit of a concern that we have two different global regimes that might be conflicting. We've got a newly emerging international monetary and financial regime that is reshaping itself in the wake of the financial crisis, and a number of the authors in this report are concerned about the extent to which many of these new regulations and new forms of advice coming out of the crisis might clash with countries' existing commitments under international trade treaties, such as the World Trade Organization, and bilateral investment treaties or free trade agreements. Let me introduce the speakers, introduce the Pardee task force, tell you a little bit about our general findings, and then I'm going to do like a 5-minute 101 about some of the key things in the trading system in case my two friends start throwing out lots of acronyms and things about trade law or financial law that not everyone is thinking about every single day, and doesn't have books about these things on their coffee table. I mean, we're really expressing concern here about the extent to which financial law and the regimes around it are clashing with trade law and the regimes around those. So we're going to hear from two exciting folks. One is Deborah E. Siegel. She's the former senior counsel at the International Monetary Fund. She spent 20 years there working in the legal department in the Office of the Internal Audit. Her specialities include international trade with a focus on the relationship between the WTO and the IMF, as well as anti-corruption laws and ethics for government officials. She worked in the private sector before and has degrees from Washington Law School, New York University, and Tufts University. Leonardo Stanley is an economist in the Department of Economics for the Center for the Study of State and Society, or CEDES, in Argentina, Buenos Aires. He's a researcher at the Mercosur Economic Research Network and teaches undergraduate and postgraduate courses in the School of Economics at the University of Buenos Aires. So a number of publications and is working on these issues for a long time. So these two folks were both part of this task force that we put together that came out of the financial crisis. Boston University has been so many fun and interesting things have happened here across the university since the crisis. We wouldn't. It's too bad that it took a crisis to bring us all together. But as Cynthia noted, one of the interesting things that's come out of the crisis is that there's been the emergence of this Center for Finance, Law, and Policy. Right after the crisis, the Pardee Center was having events about the crisis. There were events at the business school. There were events at the Morin Center for Financial Law. There's events in the economics department, and enough people started going to all these things to try to figure this whole thing out. And we realized, wow, Boston University has a lot of both professional researchers and academics and students who are doing research and are really interested in all this stuff. And I think we've all can credit ourselves for having a real interesting set of conversations about all these things to try to rethink it. And the Center for Finance, Law, and Policy is one of the co-sponsors that we have here today, and they supported this report to a certain extent. Right after the crisis, one of the things that has been done at the Pardee Center is that myself and the former finance minister of Colombia put together something called a task force on regulating global capital flows. Foreign capital flows or cross-border financial flows, bonds, dividends, derivatives, currency trades, and so forth, are things that can move around the world economy quite quickly, and on many levels are very important for investment and for employment and for productive development in economies. But depending upon the nature of your financial system and the scale of how much of this moves in different countries, it also can foster financial instability. Capital flows played a big role in the financial crisis in the United States, a major role in the financial crisis of the Eurozone, and even more so in crises in Brazil and Argentina, and certainly in East Asia in the 1990s, and certainly in Latin America in the 1980s. And in the wake of the crisis, myself and Jose Antonio Ocampo said, let's rethink the extent to which countries should regulate cross-border financial flows. To what extent should they regulate these things? What are some examples of countries that should and that have been doing this, and what are some recommendations on how to do it? Because it had sort of fallen out of favor in the 1990s and so forth. As a matter of fact, so much so that there was a move at the International Monetary Fund to change the Articles of Agreement to basically make it somewhat illegal across the world economy. So we convened here at Boston University a task force that consisted of folks from the Asian Development Bank, former Finance Minister of Colombia, folks from Central Bank, some from the United Nations, IMF officials, former WTO folks, some academics here, and we put out this report on regulating capital flows, where we recommended that in the wake of the financial crisis, that regulating cross-border finance is justified now more than ever, that there's a lot of examples of countries that are doing it successfully, and that with caution and with precision, that countries should start to rethink the extent to which they should regulate capital flows. Interestingly, at the same time, the International Monetary Fund also had its own official reassessment of this whole idea, and in December of 2012, they came out with a quote-unquote institutional view, which said that it's still the International Monetary Fund's view that eventually countries should liberalize their capital account, meaning allow foreign finance to move in and out of countries. But in order to maintain financial stability, under certain circumstances, regulations on cross-border financial flows, which they call capital flow management measures, which are traditionally had been referred to as capital controls, might be justified in some instances, and in fact, under their surveillance operations, or what are called Article 4 reports, they may even be recommending that some countries use these regulations. And there's some students in the in one of the classes that's here that have looked at some of these article reports and have found that the IMF has been recommending that countries regulate cross-border finance since about 2008 pretty regularly in a lot of countries that have had a lot of buildup of this kind of finance. So after that task force report was done, a lot of us discovered a debate that's been going on in mainly with the United States, that in United States trade agreements we make it a little difficult for a country to regulate cross-border finance. And so we decided to put together another, and a lot of this was manifest in Argentina. After Argentina's crisis, they did a number of things to try to mitigate the effects of the crisis. And a year or so later, they had over 40 different suits against them for potential violations of their different trade commitments. And so we convened a different group, a group for the task force. The first task force report were mainly economists and central bankers. For this one, we put together legal scholars, folks in central banks, Deborah Siegel from the IMF, a lawyer at the World Trade Organization, and we asked the question, to what extent are these new regulations compatible with the trading regime? And we found, and this will come out in the two papers, that there's a lot of potential clashes between WTO commitments and the ability to regulate capital flows, but not as accentuated as they are under many of the bilateral investment treaties and free trade agreements, especially those with the United States. It's a little bit of an open question about the World Trade Organization, but it's hard to find a legal scholar or a finance ministry that will say that regulating cross-border finance isn't in conflict with, say, their treaty with the United States, with the exception of the South Koreans, which we'll talk about in a minute. And so after doing this compatibility review in this report, since we had all these incredible finance ministry, IMF, WTO folks all in the room, we came up with a set of recommendations on what countries might want to do, what the IMF might want to do, what trade regimes might want to do to try to reconcile these, and we can get to that later. So I'm going to turn it over to my two colleagues, but let me just do a little bit of trade policy background in case these folks use acronyms that you don't think about every single day. Is that when we talk about the trade regime, we're talking about a multilateral trade regime which is governed by the World Trade Organization, which came out of the Bretton Woods agreements in the 1940s. There was an attempt to create an international trade organization. But heck, in just a couple weeks, they created the World Bank and the International Monetary Fund and an entire exchange rate regime for the world. And they didn't get the third thing that they wanted, the International Trade Organization. But they did set up something called the General Agreement on Tariffs and Trade, which was a floating negotiation forum to try to get free trade and a uniform playing field for the trading system over time. You know, thinking about in the wake of the financial crisis, could world leaders ever come together and create 4 institutions that were going to last 75 years? I don't think any of us would make that bet. So we won't beat them up for not creating the ITO became manifest as the World Trade Organization not until 1995 as a result of the Uruguay round. And so one of the things, when you think of trade, you know, so why are we having a conversation about trade and finance? Well, trade is very little about trade and goods anymore. When we think about trade, and unfortunately one of the things that we found is that when a trade negotiator from Malaysia or Chile thinks about trade, they're thinking about wine tariffs in the United States. They're thinking about car tariffs or trying to lower tariffs to get more shoes into their country. And that is what the trading regime was about for at least through the 1980s. But as tariffs and quotas and subsidies in goods have gone down over the past 50 or 60 years, the private sector and governments have noticed that there are things that are non-tariff barriers that are domestic regulations that impact trade. And one of the key areas has been in services. If you're older, like myself, we used to talk about tradables and non-tradables. And the non-tradables were the service sectors. But now in a globalized world, the service is trade. Anyone here coming to Boston University from another school, from another country? So you folks are services exports. We are exporting our services here as Boston University professors to your country. And in the balance of payments, your tuition payments to Boston fall under Mode 2 services commitments, because you are consuming things abroad. And heck, if you think about the 2 guiding principles in the trade regime, one of them is most favored nation. So if we're all members of a treaty, if I have a tariff on wine in Professor Bodie's country, and his is from France, because I really like French wine, but if Leonardo here is from Argentina, if I have a tariff of 4% on French wine, I can't charge the Argentines 6% for their Malbec, right? Because I like the French the best, I have to treat everybody favorably. Now, to create a level playing field for the global economy, there's also another principle in trade policy called national treatment, which means that I can't treat my national sectors. I have to treat them the same that I treat my other fellow countries. So if Susan is from the United States and she's from Northern California, I can't have a 4% tariff on French and Argentine wine and then give her big subsidies for Northern California Pinot, right? Because therefore all my consumers would unfairly be attracted towards Susan's because hers would be cheaper. So I'm trying to keep a level playing field between these two, between other countries in the world and all of my sectors in my own country. Those two are, you know, these sorry for the lawyers in the room. I mean, these things are 2,000 pages, but those are the 2 guiding principles throughout the whole thing, and a long-run commitment to try to bring along in that playing field a long-run commitment to try to keep barriers to bring them down. So to bring those tariffs eventually down to zero, to bring those restrictions on education to basically zero. So heck, if you're from Romania, you want to come here, you can come here, but I'm not going to make it harder for Tatiana from Mexico to come here. And so those are the long-run guiding principles of the World Trade Organization. Now, under the World Trade Organization, there's been a proliferation, especially over the past 15 years, of regional trade agreements, or what some people call free trade agreements, and bilateral investment treaties. The WTO, I guess one other feature to note, is that it's got over 160 something measures, and when they come together in what's called a round, we're in the middle of one, the end of one, the beginning of one now, we're not quite sure. When they come together in a round, they're basically renegotiating the terms of the treaty. And when they do that, they have to do that by one country, one vote. In the 1940s and 50s, when there was just 6 or 7 countries that won the war and basically had the lion's share of the world market, these agreements were not that hard. Now that you've got 160 countries with different politics in their own country, different comparative advantage and so forth, the process has become very slow. And not every country, perhaps not any country, gets exactly what they want when they have to negotiate with 160 or so. So one of the stated policies in the United States has been something called competitive liberalization. We're going to find countries that agree with us on trade policy and sign deals with them. And hopefully, by signing enough of those, we are going to get some of the countries that don't necessarily agree with us at the WTO to eventually have to sort of cave in, because we've surrounded them with deals that they said they didn't like. The big countries that have formed a coalition at the World Trade Organization that hasn't seen eye to eye with U.S. trade policies are largely these BRICS countries. You know, South Africa being perhaps the most important at the WTO, but supported by India, China, and Brazil, and a host of other countries have been part of. I'm not blaming them. The blame goes to 160 countries, but the whole thing has been slow. So the U.S. has said, okay, well, let's call up Colombia. They see eye to eye on a lot of these things. They have comparative advantages that they want to sell things to us. We want to sell things to them. We'll do a deal with them. There's been over 50 of them in the past 15 or so years. In the United States, and it's triggered European deals, it's triggered Asian deals, there's Latin American deals. In this hemisphere, we call it the spaghetti bowl of interlocking trade treaties. In Asia, they refer to it as the noodle bowl of interlocking trade treaties, and nobody wants to be the guy at the border that has to say, okay, Strom, your ship just came in, and where did you stop on your way here? Because each box needs to be inspected for every single trade treaty that it might go under. So there's been these proliferation of these, and these go much deeper than what you get at the WTO. They still have these two principles, but one of the things that they require is that all transfers of all covered investments, derivatives, profits, bonds, currencies, have to move in and out of the country freely and without delay. Perhaps the United States is really engaged in two big ones. Obama in his inauguration speech, or was it in his acceptance speech, or in the State of the Union, announced a trade deal with the Europeans, the transatlantic trade deal. They say he's going to complete in 2 years. And the Obama administration has been doing something called the Trans-Pacific Partnership, which deals with a number of Pacific Rim countries. It's been going on for quite a long time, but just this morning, Japan officially entered it. And so this is a major Pacific deal as well. Interestingly, China is not part of it. And so the U.S. is engaged in this. So that's, I hope that's enough basic background. I don't want to take away from these two really interesting people, but I think this might help us put some of this in context. And again, what the task force, what these two authors talk about was, to what extent is this emerging noodle bowl, spaghetti bowl of regional trade agreements and new regulations at the World Trade Organization, to what extent are those trade deals that now have financial services components in them, because not only are these services and education part of these deals now, so would banking services and financial services that are cross borders are part of these deals. So to what extent are commitments that countries are making in the trade regime on the liberalization of financial services, on regulations related to financial services, on making transfers of funds move freely without delay with trade deals, to what extent are those compatible with new ideas at the International Monetary Fund, with the Dodd-Frank bill, with the things at the FSB and the G20? That's what we looked at. These folks have the answers. I think Leonardo Stanley from Argentina will go first and outline some of the papers on capital account regulations or cross-border financial regulations and the WTO. And Deborah Siegel will talk about capital account regulations and regional trade agreements and BITs, especially those of the United States.
Okay. Okay. First of all, well, thanks, Kevin, and thanks Boston University for hosting me and inviting to stay with you. And I will just talk very briefly on three. Trying to focus on three specific points. First, on GATT's weakness, General Agreement on Trade and Service weakness. Later on, the advantage given by GATT in contrast to free trade agreements and bilateral investment treaties. And finally, some conclusions. So I will begin with that, and I should apologize in advance for my English. I'm very bad, and I temporarily export like for mode 2 of that. So I would say that the recent financial turmoil has helped to highlight the utmost importance of an effective financial regulation, as we are observing, including controls on short-term international capital movements. As the experience of emerging BRICS have shown, the introduction of capital account regulation, CARS, has also proved effective to prevent crisis, a sort of macroprudential regulation, and to alter the temporal structure of capital flows. Unfortunately, sensible measures like this could be challenged under the WTO GATT's legal framework. The obligations set forth by the GATT fall essentially in two categories: the general obligation and the specific commitments. The former are automatically binding on members from the moment in which the WTO agreement is being signed. The specific commitments are instead binding as obligation that each country decides voluntarily to assume or to undertake, particularly with regard to market access and national treatment. In other words, specific sector commitments determine the liberalization impact of the agreement for this member country. For this reason, this clause has become the main subject of controversy of subsequent negotiation rounds. In particular, state members who have committed to grant free access to financial service markets under Mode 1 and Mode 3 are in fact requested to liberalize capital flows which are strictly connected to the service provider. As a consequence, a number of concerns arise regarding the ability of nation-states to deploy CARS, in other words, to deploy capital controls, while keeping their commitments under the GATT. In other words, the conflict between re-regulation and existing WTO rules remains, as highlighted by the 2009 UN Stiglitz report. Nonetheless, it is fair to mention that WTO members do have some space to introduce these capital accounts regulations. In particular, three specific exceptions allow members to elude GATT's limitation as follows. First, member states are allowed to introduce capital controls satisfying an IMF request. According to Article 15.9. Article A of the GATT, of the General Agreement on Tariff and Trade, a measure restricting capital transaction that is consistent with an IMF obligation should not lead to a finding of breach of GATT's WTO provision. A second exemption is allowed in order to safeguard members' state balances of payments. It follows that members are not only permitted to impose temporary trade restriction, but they could also introduce current account restriction service-related payments. However, as mentioned by Todd Tucker in Chapter 2, there are a number of incompatibilities between the ability to regulate cross-border finance and disciplines under the World Trade Organization. The GATS balance of payments software does not adequately guarantee nations the possibility to regulate both the inflow and outflow of capital because there is no reference to derogations to maintain financial stability. Third and finally, controls could also be introduced in order to ensure the integrity and stability of the financial service sector, the so-called prudential carve-out clause. This prudential carve-out clause could be adopted regardless of the member state's specific commitments on market access and national treatments. The problem is some lack of definition. The prudential carve-out provision has also proved tricky. In Article 12, the GATS does allow to use cards for crisis management purpose and on a temporary basis, but as detailed in the book by Andrés Arauz at Chapter 4, GATS precludes its introduction as macroprudential tools for crisis prevention. In Chapter 5, interestingly, Luis Fernando da Paula and Daniela Magalhães Prats illustrate the distinctive institutional path followed by Brazil. Brazilian authorities have only made commitments on their Mode 3 commercial presence and limit the entry of foreign banks as the admissions process was carried out on a case-by-case basis. But those were the disadvantages to some extent, so the problems we could find at GATS WTO. There are also some aspects which led us to support, to some extent, this legal framework. In the introductory chapter, Kevin Gallagher and I have underlined a series of advantages favoring GATS WTO over a myriad of preferential trade agreements. Under GATS, all commitments are made under the mechanism of positive list, as opposed to the negative list approach followed by bilateral investment treaties or preferential trade agreements, FTAs. Any dispute arising from the imposition of regulatory measures would be settled under a dispute settlement understanding mechanism. This is a second advantage. In contrast to the a sort of state-to-state dispute settlement space that contrasts to the investor-state dispute settlement mechanisms included under the BITs or FTAs. Above all, in spite of all these imperfection we were talking in the first part, the WTO remains a democratic space, as highlighted by Kevin, from the principle that each country has a vote and remains equally represented. In other words, cards are being actually more than limited by preferential trade agreement, as stressed by Hector Torres at Chapter 3. As stated by Ana Maria Viterbo in Chapter 1, at the end GATS does not contain a general obligation to liberalize capital flows. Therefore, unless a member has voluntarily chosen to be bound to a schedule of specific commitments, the country remains free to adopt capital controls without violating any GATS rules. This author, Ana Maria, also remarks the possibility of transforming GATS into a code of conduct for capital controls by virtue of clarifying or transforming some of the GATS exceptions cited before. So, in conclusions, the World Trade Organization development objectives remain partially unfulfilled. In this sense, we are trying to give some last words. I mean, the founding fathers of the Bretton Woods institution share a common vision. In order to prevent a new phase of economic instability, they instead intended to create a rule-based multilateral framework, imposing clear obligations to the contracting parties and providing the adoption of protectionist and bigger-by-neighbor policies. Under Bretton Woods systems, states remained free to introduce restrictions to correct imbalance created by capital flows. Unfortunately, since the 70s, the international financial system turned bolder. GATS and preferential trade agreement liberalization of trade and investment in financial service has significantly helped the adoption of very risk strategies and business models that eventually fueled the financial crisis. Current negotiations to liberalize financial service as part of the WTO Doha talks on GATS and multilateral negotiations for a redesigned the service agreement are still based on a pre-crisis GATS model that honored and ever promoted the light touch regulation of the banking system and financial liberalization. In other words, it must be argued that for the WTO GATS systems, the stability of the financial system might become a greater concern than the openness of the financial system at times. But still liberalization remains embedded in its long-run goal. I mean, it remains liberalized the objective. Okay, thanks.
Thanks a lot, Leonardo. Before we go to Deborah Siegel, let me add. You mentioned some terms that I guess I should highlight and maybe try to summarize a little bit. And so we've got these two regimes. We've got the World Trade Organization, World Trade Organization, which is the multilateral trading regime, and then all these bilateral deals and regional deals. Under the WTO, as Leonardo said, there is the General Agreement of Tariffs and Trade and Services, which deals with all sorts of services like the education, but also financial services and banking services. Now, when you sign up at the WTO, you, under a negotiation under the GATS, the General Agreement on Trade and Services, you can have a negotiation about liberalizing financial services. He used the term positive list, right? So to make that accessible to all of us. That just means if I'm negotiating with Strom Thacker's country and we want to have a discussion about the liberalization of financial services in his country, I am going to ask him, I'm the United States, he's say Mexico, I'm going to ask him to liberalize his financial services sector. And he will put that on a positive list, meaning positive. Positively, yes, if he agrees with me, he will list that as a sector that he will liberalize. He may put a limit on that, some caveats and footnotes about certain things under certain circumstances where he wouldn't liberalize it, but in general, he will list that. That stands in stark contrast to what might come up in the next presentation, although what Leonardo said is that, say I'm negotiating a deal with Colombia, with Juan Blanco from Colombia, and the regional trade deals usually have, bilateral investment deals have something called a negative list. So we're assuming that you're liberalizing everything except for the sector that you list. And so he might say, I'm going to liberalize education, health, but not finance. And so it's a little bit of a dynamic. That's what he was talking about with positive lists. Leonardo also talked about inflows and outflows. So there are different reasons to regulate inflows and outflows. In general, you want investment to come in and out of a country with the market determining it, but in certain circumstances there can be surges of inflows of capital, especially non-foreign direct investment, short-term money such as currencies, derivatives, stocks, and bonds. A lot of it can build up in a surge that can go into a country really fast. That can increase the exchange rate. It can move into asset sectors and cause asset bubbles, which if there's a sudden stop in investment, okay, the money could move out of the country and those assets, the collateral under those assets could collapse, the exchange rate could collapse. And there could be severe financial damage. On the inflows side, the damage can be in terms of currency appreciation, and therefore you can't export things, and you get the credit bubbles. And when there's a big devaluation, that can obviously have severe impacts on the other end. To put this in the real world, 2010, Brazil was really worried about a surge in inflows. They had a 40% appreciation of their currency. They had a massive credit bubble in the real estate and in the stock market. And they were worried that too much inflows were coming in from monetary policy in the United States, that they couldn't handle it. Their exporters, they're a big exporting country. Their exporters couldn't compete with other countries that sell other goods. And a lot of research has shown that because of that, it's one of the reasons why the country's slowing down now. Well, they tried to put in place tariffs, taxes on some of those inflows and on foreign exchange derivatives to try to slow down the buildup of that risk. A present-day example is South Korea. One of the big things in the news this week is the massive monetary policy in Japan that has brought the value of the yen down and interest rates in Japan very, very low. So a lot of countries are investors are borrowing money in yen in Japanese banks and investing in places like South Korea. So the South Korean won is appreciating significantly, and there's a buildup of risk there. And so South Korea has regulations on foreign exchange derivatives and on certain kinds of bonds and stocks coming into the country to try to stem that. Those are regulations on inflows that are usually temporary and countercyclical to go in during a surge to try to temper the effects of a surge. Now, he mentioned outflows. That's where you can think Iceland and Cyprus. The world is giving us plenty of examples of these things, right? So outflows regulations are often when there's a massive devaluation of the currency and there's a lot of capital flight from the banks from the country, and there's a run on banks leaving the country that could put the country in dire straits, and often a banking authority or the International Monetary Fund will recommend that they limit the amount or tax the amount of capital leaving the country to try to stop a disintegration of their banking system and a massive drop in their exchange rate. Why does a massive drop in your exchange rate really hurt? Isn't that what those Brazilian exporters wanted when their exchange rate was expensive? Well, if you have a lot of debt and your debt is denominated in international dollars or in euro or in yen, and the value of your local currency goes down, your balance sheet or the amount of debt that you owe has just exploded. Okay, and so financial authorities are really concerned about that. And so when we talk about does the WTO or does a regional trade agreement or a bilateral investment treaty give countries the proper policy space for what the South Koreans, the Brazilians are doing, and as we'll hear that the International Monetary Fund is starting to recommend, we're asking to what extent are those kinds of instruments permissible. To summarize, Leonardo, at the World Trade Organization, it's 100% permissible if you haven't listed liberalizing financial services in your General Agreement on Trade and Services commitments. So under your GATS commitments, when I called up Strom and asked him to liberalize his financial services sector, if he said no, like Brazil did, and said, but I'll do the health sector, then he can do whatever he wants. And that's actually, we have a chapter in here by 2 Brazilians, and Brazil has not made commitments in financial services under the GATS, and so they can do whatever they want. Also under the GATS, if Tatiana from Colombia had said, or from Chile had said, yes, I will liberalize financial services, but I'm going to put a limit on them. We have this law at the central bank called the encaje that allows us to put a tax on inflows for a short period of time when there's this kind of buildup. We'll liberalize, but we want to reserve the right to use that law. You can do that too under the WTO. Even if Susan was Colombia and liberalized under the WTO, meaning listed its financial services, didn't put a limit on it like the Chileans did, and she decided to use some sort of a regulation on inflows or outflows. Leonardo talked about 2 different exceptions in the WTO that you might be able to get through. One of them is the balance of payments exception, which says that under extreme financial difficulties, you can use these measures. And another one is what he referred to as the prudential exception, which says, well, to try to deal with issues for prudential reasons, a nation may make certain interventions into certain violations of their commitments. And many of the legal scholars and central bankers on the WTO one are not much of a consensus there. Some of them are really concerned that the balance of payments only allows an outflow sort of Icelandic situation, because it says under extreme, lawyers really argue, we had to watch the lawyers argue about 2 words in a paragraph for 2 hours, but under extreme circumstances, that says more to most in the legal community that, okay, the Cyprus-Iceland kind of thing is okay, but not the tax that Brazil has or the foreign exchange derivative regulations that the South Koreans have. Sorry to go on, and we'll leave questions till after, I'm sorry, but just to help clarify and accentuate. Deborah Siegel, formerly from the IMF.
Yeah, hi. Well, Thanks everyone for coming, and thanks to Kevin and Cynthia back there for inviting me. It's an advantage to go last because you have a lot of background that's already been given to you. I'm going to talk mainly about the relationship of the trade side to the IMF. As I was listening to this, I decided to start with a point that I had in my prepared remarks a little later, but it occurs to me that it's important background to notice that in some ways, to use a cliche, we're talking about apples and oranges. Because let's look at what you want in a trade agreement. If you come from, and let's take the US, from the trading agency of the US called USTR, your mission, what is your mission? Your mission is to open markets in foreign countries for US products. And as part of that mission, you want to protect US interests when they go into those foreign markets. You want to make sure that the services that you're provided there will be allowed to be distributed. You want to make sure that the money for those services goes in and then the payments can come out. And if your investors are in that country, you want them to be protected from any controls on them benefiting. That is their mission. That's, let's say, the apple. What's the IMF? Well, that's the orange. The IMF is an international organization. It has a charter that establishes it, so in a way it's an international treaty, but most of these trade agreements do not establish an organization with an institutional role. Now, the WTO has been created as an organization, but that's another lecture on the differences of the organization. But I think it's a pretty fair summary that trade is covered by treaties, and the IMF is an organization with its own mission. But its mission is not that of promoting the interests of any individual government. Its mission is to have governments work together and to help countries in difficulty promote their abilities to relate to other countries. And that's why it has rules on exchange rates, so it can't interfere with trade by manipulating its exchange rate. That's why, as an organization, it provides financing to members in economic distress. And that's why it has this function that Kevin alluded to called surveillance, which are regular meetings with countries to take stock of how things are going. And that happens to fall under Article 4 of the IMF's charter, and that's why they're called Article 4 reports. So what I would like to do is touch on 3 ways to look at how these apples and oranges interact. The first is why capital control issues fit into the law and the work of the IMF at all. The second is how that work of the IMF is impacted by this proliferation of treaties. And the third is the flip side, whether what the IMF is doing impacts in the other way. So on the first topic, how capital controls fit into the law and work of the IMF, I want to do a quick primer on that law, the legal system of the IMF. And I'm going to try out this analogy. Several years ago, some of you may remember in this country, there was a big controversy over a former football player, O.J. Simpson, who had been accused of murdering his wife or suspected of being involved in the death of his wife. And he was tried for murder in a criminal court but found not guilty. On the other hand, his wife's family won a civil suit against him. And I remember at the time a friend of my mother's asked me as a young lawyer, how could he be guilty, not guilty in criminal court, but guilty in civil court? And so of course the answer is that he wasn't guilty in civil court, that they're both legal actions, but they're very different kinds of standards. And there's very different kinds of consequences. So in criminal court, you have to really show guilt by preponderance of an evidence, and in civil court, beyond a reasonable doubt. In civil court, there's a lesser standard. You only have to show by preponderance of the evidence. And the consequence is not that you go to jail, but that you have monetary damages. You have to pay the victim. So when we look at the IMF, I want to bring that idea that there are different functions of the IMF, and they're legally pretty different from one another, but they all form part of the legal system of the IMF. Concerning capital controls, at one end of the spectrum is the fund's jurisdiction, which maybe has the strongest legal consequences, but I think it covers the smallest area of the type of capital controls we're talking about. Under the fund's what we call jurisdiction, certain restrictions are actually required to be removed, and the legal consequence for not removing them is a breach of obligation. So that's pretty strong stuff. But the area of capital transactions covered are those that are included in a list of actually current international transactions, but that have some capital components, because that strong set of the rules under the IMF's jurisdiction is really directed at current transactions. But there are some included, and that includes amortization of principal on debt instruments, depreciation of direct investments, and normal short-term banking facilities. At the other end of the spectrum in the functions of the IMF, I'll say is surveillance in this context, because it covers perhaps the broadest range of the types of capital transactions that we're looking at, but it has a lesser legal consequence. And I'll say at this stage it has a lesser legal consequence because the fund has the authority to treat those as obligations, but they haven't chosen to do so now. And instead, when they discuss these issues, it's in the context of policy advice. So there aren't concrete legal consequences for not following it. In the middle of these two, in terms of comparing the strength of the legal consequences and the range of capital transactions we're looking at, is the fund's financing function. And that's what I was talking about earlier. If a country is really struggling and it needs financing from the fund to support its balance of payments and be able to pay for its imports, that's usually provided under what we call a fund-supported program, where the country and the fund work together to decide how are we going to adjust this economy and get you out of this crisis, and we'll provide you financing in the meantime to get there. But as you've all, I'm sure, heard in the news, it's usually the program lays out a step-by-step process with conditions for getting the financing. So fund conditionality is yet another piece of the legal system, the civil law part, if you will, that if you don't meet the conditions, you don't get the financing. It's not a breach of obligation, but it's still a kind of legal consequence. So, taking that backdrop of what the fund is and what it's trying to do, how do these trade agreements interact with that fund's legal system? I'm talking about, in particular, bilateral investment treaties, which are usually just very focused on investment, and the acronym is BITS, Or there are these broader regional agreements Kevin mentioned that are often called free trade agreements, and they cover a broader range of trading between the countries. But more and more now, I'd say, even without exception, they have a chapter on investment or a chapter on services, like Leonardo was saying. And so we have to look about how, I forget which fruit I did, the apple of the trade agreements interacts with the orange of the IMF. And the concrete problem is, as Kevin said, making sure that countries still have choices, that they still have the policy space, which is, you know, the term of art now, to use certain capital controls, or now they're called CARs, or the IMF is referring to them as capital flow management measures, the type of measures that Kevin was outlining, that as circumstances evolve in their economy and unanticipated crises develop, can countries actually use these measures? And the potential problem is that in the context of these trading agreements, some of them are written so starkly that they don't allow this policy space, that they articulate, you know, I'm not quoting, but, you know, thou shalt not ever impose capital controls on the investments that are covered under these BITs or FTAs. And some of them have the kinds of exceptions that Leonardo was referring to, and some of them don't. Most of them don't have the broad crisis safeguard that is in the GATT and the GATS, which says in the circumstance of a balance of payments crises, there is permission to deviate from this rule in your trade agreements to impose these kind of restrictions. So, if the fund is working with a member to help them resolve a financial crisis, and part of the economic program involves a condition that until we get your act back together here, there may be some kind of regulations. And if that member is not permitted to take that measure, it could interfere with the program, and then the member would not be have access to fund resources. So that's where I'm comparing the kind of bilateral self-interest that is part of a trade agreement to the work of an institution like the IMF, which has a mission to resolve crises and help countries interact with each other generally. There are a couple of technical, legal conflicts under jurisdiction, but I'll save those for now. But I think the bigger story is in the context of surveillance. And I think Kevin and Leonardo described it well, that when the IMF meets with a country every year and they look at how that their economy is evolving, how the global economy is evolving, the types of issues that Kevin mentioned and the types of measures may be appropriate. And so if the country has made commitments under these trade agreements that essentially tie their hands without the kind of allowance for exceptions, that's when we have well, it's not a legal conflict, but you can see you have the apples and oranges kind of hidden up against each other. My last topic is the converse of that, which is some concern whether what the IMF is doing is causing concern on the trade negotiation side. And my comment is that is going to be pretty short, because the work of the IMF is not, doesn't have the power really to interfere with these trade agreements in any way. And in particular, their current set of thinking, which they have articulated in this so-called institutional view on these capital flow management measures on CFMs, is basically a set of guidelines. And it's interesting to see that it was the result of, bringing together a crystallization of ideas on how best to address CFMs over the years, and also almost 2 years worth of papers that have been brought to the executive board, discussed, thrown back to the staff to think about some more, and culminating in the paper Kevin referred to that was finally published in December of this year, unfortunately like days after we had to push the button on publishing the task force report. But so the fund now has this institutional view on capital flow management measures. But if you get a chance to read that final paper, it really makes very clear that this is a crystallization of ideas. It doesn't change any obligations for the fund members. It doesn't change any of the rights and obligations of members as compared to other treaties. It is meant to be informative and guide staff in an intelligent way to try and draw on the wisdom that has been collected over the years. So the fund will not be advising members to breach their obligations if they have them under free trade agreements. They will be working with countries to take the measures that they think they are appropriate and to work around their legal obligations. So my punchline is that the stark provisions of the BITs and the FTAs interfere more with the work of the IMF under its legal regime than the other way around. And that's why I think many of us in this task force recommend that work be done on a multilateral level to ensure that these agreements, as they are getting written going forward, do include the kind of exceptions or the kind of means to allow the policy space. And that doesn't mean to swing the pendulum all the way back to no rules on capital controls. It means to find a balanced and reasonable way to regulate flows as they are may be important under specific circumstances, and to find a way to address the apple and orange, and to keep in mind the difference between bilateral self-interest and multilateral review of the global system.
Thanks a lot. Well, thanks. We've got a good half hour to have questions and answers about this. I know Zvi did. We're all here from different parts of the university and some other universities, so when you raise your hand, tell us who you are. And Cynthia has a microphone, even though we can definitely hear you. They podcast recording purposes. So please, can you give Zvi?
Hi. My question is really...
Who are you?
Oh, I'm Zvi Bodie. I'm at the School of Management. I teach finance and economics, and I have written on some of these issues, but not at all from the legal point of view, or even from so much the policy perspective, but rather about the fundamental economic and financial science, if you will. How do these markets work, okay, and what is feasible and what is not feasible. So I think about things like, can individual governments or even multinational institutions stop arbitrage in international capital markets? And if they try to, what are the consequences? Okay? My question is, how can you make rules and regulate a system where there is fundamental disagreement about how the system works among economists? And I'll just give you one example, because it's so fundamental and it's going on right now. The IMF traditionally, when it would come in to resolve, let's call it bankruptcy, because that's essentially what it is. When a company is on the verge of bankruptcy, it's not legally bankrupt, but it defaults on its debt or is about to default on its debt, and says to the IMF, bail us out. Argentina has a lot of experience. Yeah. Now, a couple of questions arise. One is, if the IMF comes in, as it typically did, and I don't know if it does this anymore, and it says austerity is the solution. Well, we know that there are two schools, at least, of thought among economists. Those who say that austerity is what is typically needed, and those who say, no, it's the exact opposite. If you impose austerity, cut government spending, raise taxes, you're going to shrink the underlying national economy. What you want is to stimulate the growth of the underlying economy. That's the exact opposite. So that's, in essence, my question. What do you do when there's fundamental disagreement about the economic science?
Let's take a couple and answer those as a group.
Hi, my name is Gloria. I'm from the Department of Economics. And I have a question regarding the scope of the most favored nation clause. I understand that that is included in most of the bilateral and FTAs. So probably I don't understand that very well, but the way I think is, if country A and country B have a treatment and they say, okay, for this good we are going to have a tariff of 2%, and then country B and country C have another treaty and they say we are going to have on the same good a tariff of 1%, then country A say, okay, we have an agreement first, so I also will get that 1%. Is that right? So I would like to know if that most favored clause has some impact on that type of balance of payment exemption for capital controls and things like that, or for that type of how can I say this?
I think I understand the question.
Okay.
I can answer that when you're ready, if you like.
Thank you.
Thank you so much for an illuminating talk. I'm Cornel Ban. I'm a professor here at BU, International Relations. I'm in general very intrigued by dissident research coming from within the IMF, and we've seen a lot of it on current account, more recently on fiscal policy. But I wonder who are, is there any research in the IMF that sort of pushes back against this revisionist thought that has led to the guidelines? Are there holdouts among IMF economists who stick to the old line of the 90s?
Thanks. Let's answer these three, and then we'll take another round. You want to start with the trade?
The most favored nation. I can't resist a first comment that I think it's one of the dumbest names that policymakers have ever come up with, because it's actually counterintuitive. It makes it sound like somebody's getting the best deal. And what it means is you have to give me the most favored deal that you gave to anybody else. And so it does raise the bar to everybody, but it's really an equalization measure. It's not a most favored measure. But I think the way you described it was essentially right. But I find it helpful to get away from the words and think about the concept. The reason I think this is really a legal question is there's a difference between what's written in the treaties, which is I'll give you 1% tariff, or I won't prevent foreign deposits or foreign banking services. In that case, that would be subject to this equalizing treatment that you have to give the best deal to all your trading partners. But if you had to exercise one of the exceptions, if you had to impose, you mentioned a balance of payments crisis, or impose that safeguard, you're taking an action under the treaty. You're not drafting the treaty. So you're allowed to take the action that's provided to you under the treaty. You do have to act in a way that is non-discriminatory among your trading partners, but it doesn't really come up that whether the providing that. I guess another way to look at your question: if you negotiate a treaty with me and it has a balance of payments safeguard in it, you're not required to include that safeguard in the treaty you may negotiate with SVI.
I think her specific,
I'm sorry, did I get to the question?
What she's specific, yeah, you're definitely in the neighborhood, but I think I know what she's trying to get at. In Pat, before she came here, she worked for the Colombian Central Bank, and she's learned that the United States trade treaty with the Colombians does not have a balance of payments exception, and it doesn't allow them to regulate cross-border finance. However, with the South Koreans somehow got a better deal with the United States, and there's an annex that allows their particular law that allows them to put taxes on inflows. We can let the South Koreans do that, and so she's an economist, not a lawyer, wants to make sure she understands that since both countries have to adhere by most favored nation, can Colombia say, hey, you let the South Koreans do this, we can do it too? That's what you're getting at, right? Yeah.
Right. Not all aspects of the treaty are subject to most favored nation. I guess one way to look at it would be the specific concessions that you make, your level of tariffs, whether you let in depositors, but some aspects of the treaty, like whether there's an exception for BOP, are not part of most favored nation. And I guess we'd really have to look at the precise provisions to, and I'm sure the lawyers in your country are doing that, in terms of what they would have grounds to go back to the U.S. and ask for that better deal. But I guess the short answer is not the whole treaty.
Yeah.
I'll try. Oh, go ahead.
Yeah, no, I will try to answer, to begin with the answer to Professor Boyle's question. I mean, in terms of what has happened, how can we solve this disagreement? No? In the past, until 3 years ago, was a huge agreement on capital account liberalization. The problem comes with the crisis. This agreement comes because Keynesians and neoliberals are fighting each other to see where the mainstream policy will be in the future. So the point is developing countries or emerging markets are pushing to some extent to introduce this new mainstream policy. Trying to be back at Keynesian years. That's for one part of your point. How to do with this disagreement. On terms of how to manage the crisis. I mean, coming from Argentina, but I mean, coming from the Latin America, but we'd say from all over the world. I mean, the point is there is no kind of institutional setting for bailing out a country. I mean, as Argentina showed in 2001, but also all the other countries. I mean, there is not something equivalent to Chapter 11 for films. That's the point that the project of the IMF by I mean, by the time Argentina was in the middle of the crisis, was not sorting out. I mean, so we just went to, you know, we have all the problems with the holdouts, etc. I mean, and it remains, the problem remains unsolved, I mean, to some extent. So I just say that beginning was your answer, one of your points, and now.
Let me add to that on the. I totally agree. There's a big debate in economics about this. It's become much narrower than it was in the 1990s. And so your question is, well, gosh, how can, you know, since there isn't a consensus on this stuff, how can the IMF have a clear, you know, why should it pick a side or something like that? What we've shown in this task force is that that unfortunately certain countries have picked a side already, and the question, and the IMF isn't trying to pick a side. She's this institutional view are making sure countries have choices to make their own choice. But U.S. treaties are sort of stuck in the 1990s, and they've picked a side and said liberalization is optimal. It's more driven by the fact that U.S. firms want access to the markets, but it had in the 1990s an economic theory behind it that said, hey, capital account liberalization is an optimal thing. So the economists are saying it's a good thing, and all of the U.S. interests want it, and so let's go into a country and tell them they're crazy if they want any limits on this stuff. And so we signed all these treaties. The treaties have made that choice already, and now the economics is much more contentious. The preponderance of evidence on the econometrics of capital account liberalization and growth shows that countries that liberalize their capital accounts don't grow until they've hit a certain set of institutional thresholds. Most emerging market and developing countries are under that threshold. And countries that liberalize their capital accounts are more prone to banking crises. This is in the Rogoff and Reinhardt stuff. There's also a lot of new research by the IMF and by the NBER that shows that those countries that regulate cross-border finance, that they've shown to have a statistically significant and important effect on these limits. So one, the regulations work, and two, full liberalization hasn't brought the benefits that were shown in the 1990s to deliver. And now there's even new theory. Some of the stuff has been co-authored with people at the IMF that thinks about financial markets in a public goods and second best framework, where if realizing that individual investors don't necessarily have the perfect information at their disposal to know whether or not that their extra dollar borrowed or their extra dollar lent could be the one that could tip the scale and cause a crisis. And so it's a classic market failure that a intervention like Brazil's tax on inflows is actually an optimal thing and not a distortion. And so there's been a lot of economic theory on that and simulations done that show that when countries put those things in, they'll actually grow faster because they'll be correcting for a distortion. That's still controversial. The econometrics is not controversial. It's all less controversial than it was in the 90s, but the U.S. has already, some treaties have already made the choice of saying in the 1990s what our task force has exposed and what comes out in many of the in the IMF institutional view. They have a quote in there, maybe you're going to read it, that says that a lot of these things are incompatible. They've made a choice that says you shouldn't regulate this stuff, and that's some people would say it's right, some people say it's wrong. What we're saying is a country should have the choice. Well, there's one more question from Cornell for you.
Yeah, thanks. No, I think you presented that very well. I think that captures it. I'm sorry I can't give you a precise name or anything, but I was looking through the paper to see if, you know, some of the writers, some of the research papers cited, you know, were flagged for, you know, representing the contrary view, and it's not immediately obvious. We'd have to look at it. But Austria is one of the people at the fund who writes a lot, and if you're interested in and looking at this, there's two sources. One is the papers that come out of the research department itself. And then there's this, and those papers represent, well, the research department is more independent than some of the other departments which have to toe the party line. But even more independent are a set of staff papers that, you know, would be under a different tab on the website. And in that case, individual staff members have an opportunity to publish their own views. So those are two sources that you could look at to answer that question.
Can I have a quick follow-up?
Nope, because I didn't let him have one either. Let's have a couple more, and if there's room for you two to have a second question, we will. Sorry. I guess people want to hear what these two questions are. Oh, no, we have one here.
Thank you. I was curious, given the current climate post the financial crisis, compared to the climate post the Asian financial crisis and the IMF's role in both of those circumstances, I was kind of curious about what the IMF is, where it's directing itself in terms of its position in the world on these matters, given that now you have an apparent behavior change in terms of the acceptance of these, at least in terms of the institutional view and in part coming from parts within the IMF. And I was curious, the IMF is saying that it will not interfere with these treaties. Is it just acting as an advisory capacity towards the future? Or I'm just curious because the IMF is uniquely situated in the world system to be where it could be an international lender of last resort, it could be an international regulator of types of things, and I'm curious if the IMF is moving closer to that or farther away given the rise of regional possibilities such as in Asia and elsewhere, and I'm just curious if you could speak to where the IMF sees itself moving forward in terms of capital account regulation.
Let's see if there aren't other ones. We can go back to Zvi and Cornell. But I encourage other folks to ask questions. No? Okay, so Zvi and Cornell each had a
Mine
follow-up.
is actually related to your question a little bit. Oh, I'm sorry.
You think this guy needs a microphone? They can hear him podcast it to China. Go ahead.
My question is related to that question, and it's but it's more specific. And it relates to something that's in the news right now, credit default swaps on sovereign debt. Now, markets speak when it comes to credit default swaps. Everyone looks at how big the spread is to get a objective, market-driven estimate of probability of default and severity of default. Some national governments have decided to ban credit default swaps within their borders, or naked credit default swaps. Now, of course, that's the supply. So if you ban the supply, you're essentially banning the market because they trump up some charge. Essentially, they don't want that market signal because it doesn't reflect well on their government. That would be one explanation. I think the only logical explanation for banning it. The IMF has come out and said, you can't do that. Or at least they are saying it's a bad thing. How does that get resolved? How does that relate to, let's take credit default swap. Is that a service? Okay, if I'm a market maker in credit default swaps, am I considered a service provider?
Good question.
Thank you, Deborah. I have an opposite question. It's more general. Do you have a theory of what it takes to change orthodoxy inside the IMF? Because this is one of the few cases where we saw a half step, as some people put it, but it is a departure from the 1990s. It is a qualified endorsement of some kind of intervention. What does it take to get there? You don't have to give names or institutions and so on, but in your perspective, what are the kind of factors that can power a critical mass of people coming on the revisionist side, and that leading up to an official endorsement of that revisionism that we are seeing now?
Okay, we got to start with Nathan.
Sure. Well, I'm going to say something that maybe ties together all three. You mentioned the Asian crisis and then this crisis. The fund has really evolved over that time. And it's, you know, we talk about the living Constitution of the United States. I mean, the Articles of Agreement also have that ability to allow the fund to evolve as it needs to. You know, after World War II, when the fund and the World Bank were created, the international community had a particular view about capital transactions. And that's why there's certain language in the IMF articles that reflected that international view at the time. But there are other provisions in the IMF articles, and that's why I think talking about it's so important to look at the different functions, and because there's different legal rules for all of them. So when the Asian crisis hit, I think it was a turning point in causing the IMF to realize that it had to broaden its work. And some of us in the legal department had to learn something I had avoided at all costs in my private practice, was learning bankruptcy law. And why that? Because if a country is in financial crisis and all the corporations are having difficulty, and some of them are going insolvent and some of them are going out of business and the creditors are getting pinched, how are you going to resolve the economic crisis in the country unless you have an orderly system of insolvency and bankruptcy? So those of us, several of us had to learn bankruptcy law, and I did manage to ease out of that. Other people worked on it. But to me, it was very striking. And you never thought that working in-house at the IMF, you'd have to learn about corporate bankruptcy law. And so another thing that came out of that was the beginning of attention to the financial sector. And that, of course, exploded in the more financial crisis. So I hope I'm remembering your exact question, but I think the first part of it was, how did the work of the fund kind of change over time and get us to looking at these issues? And I'll come back to your other part in a minute. I think that answers a little bit the question in the back, that part of it is the development in the international global system. And then there's work at the ministerial level. You know, the G7 and the G10, they issue communiques that say, IMF and World Bank, thou shalt look at these issues. So that's another way those issues come about. The evolution of thinking comes about. In a more down-to-earth way, when staff changes, new staff comes in. The IMF made some real efforts to get more of a rotation of staff, to find ways to help people who are thinking they'd like to move on, that, you know, economically from their pension standpoint, there wasn't a disincentive to do that. And at the same time, there was a hiring of new expertise. And that gets back to this other question up front, that, you know, I saw a change in my department and in other departments, that they hiring lawyers who came from the banking divisions of their law firms. And we never had that in the first 10 years I was there. it changes as the world economy changes. And so in terms of how the IMF is looking at what they should do on capital controls, there's a couple of parts of this paper that I think, address that head on. And, let me just read the first couple of sentences of this executive summary. It says, capital flows have increased significantly in recent years and are a key aspect of the global monetary system. They offer potential benefits to countries, but their size and volatility can also pose policy challenges. The fund needs to be in a position to provide clear and consistent advice with respect to capital flows and policies related to them. In 2011, the International Monetary and Financial Committee, which is made up of, at the ministerial level, called for further work on comprehensive, flexible, and balanced approach for the management of capital flows. And then, later on in this paper, it talks about how the IMF is going to think about capital flows in its surveillance function. And at this stage, that's largely on the level of policy advice. So that's why I said it's not going to advise countries to conflict with their obligations under the free trade agreements. But if reading the institutional view, and there's a really good, it's which box it's in a box in this paper. It's so strongly emphasizes the need to look at the circumstances, and that different measures might be appropriate in different circumstances. And maybe there's some that are you look to avoid, or you're really the least desirable, because the two issues why a measure may be considered undesirable is it really going to be effective? And is it going to achieve what, so is it going to be effective and achieve what you want to achieve? And actually, is compliance assured? Because some of the measures that are imposed are very leaky. So there may be reasons why some measures are lower down on the hierarchy of the possible range of measures to be recommended. But this paper couldn't have been clearer, I think, that the thrust of it is to consider the circumstances. Here's a set of guidelines that our experience shows us might be the best approach in those circumstances, but nothing is set in stone. This view does not set anything in stone. Yeah, so I don't know, I think I've touched on everybody's question. I don't know if I've answered it to the full extent. Yeah, okay, thanks.
On the credit default swaps, I mean, in neither the fund work nor our task force, and I think most of the economics would show that when it comes to capital flows and this systemic risk, the credit default swaps are not, they are not causing any of this risk. They might indicate how risky a country is. And so this report is looking at, in terms of derivatives, foreign exchange derivatives are definitely a channel that have been identified in some of the fund reports and that we look at, and that some countries have regulated. So Brazil has limits on positions that you can take on dollar positions, and South Korea has a tax on foreign exchange positions to try to slow that down. So the CDS market will pick that up if they see that being risky, but this isn't a target of the regulation. Now, there are lots of other reports like this that are looking, we're looking at one tiny little piece, right? Cross-border financial regulations and the trading system. But there's a larger debate in the New York legal community and in the legal profession in general about financial regulatory reform and trade commitments. And so that is where there are lots of New York law firms that have little pieces about the naked swap bans and so forth in Europe, and the FTT, the financial transactions tax, and the extent to which that violates their commitments. We don't deal with that here. That's not in the IMF piece. This is on cross-border financial regulation related for booms and busts, not not general financial reform. And there's major debates. And yes, if I have a ban on naked swaps, And I have made Mode 1 and Mode 3 commitments without any limits for new financial regulation that might come up 10 years down the road because I might have a crisis, then I am fundamentally in violation. So the question becomes then, are these two of those treaties, right? Of those treaties, but the question is, no one's tested whether a CDS can get through the balance of payments exception or the prudential exception. And so there's a big debate. Some New York law firms say that the prudential exception is too big, you can drive a truck through it. And so every regulation that everybody from Argentina to the Germans, if that's a spectrum, that they'll come up with, you can get anything through there, whereas it should be more narrow. But we don't. That's not really part of the economics or the policy that we're looking at here.
If I might just say one thing, inject a thought, and that is, traditionally, capital regulation has looked at cross-border flows of funds. But from a modern finance perspective, cross-border flows of risk transfer through guarantees, whether private or public sector, are just as important and inseparable in many ways because they affect the flows.
Well, it's 1:30, 1:34, so we went 4 minutes off. Thanks again for all of you for coming. Thanks to the Center for Finance, Law, and Policy and the Pardee Center for coming together and bringing us all together. If you want to talk more about taking stock on the financial crisis, go to the conference at SMG. And please especially thank our two visitors to Boston University today, Deborah Siegel and Leonardo Stanley.